All right, let's talk about Darden Restaurants. Their latest earnings report just dropped, and honestly, it created this classic Wall Street tug of war. On one side, you have these fantastic sales numbers, but on the other, you've got some serious pressure on their profits. So let's dig in and figure out what this all means for the stock. So here's our game plan. We're going to start with a quick snapshot of the big numbers. Then we'll dive into the two competing stories here, the awesome sales growth and the margin headaches. After that, we'll check out management's playbook for the future, and we'll wrap it all up with the next call, our official rating, and what we think is a pretty interesting trade idea. Okay, let's get right into it with the headline results. This is where you can immediately see that core tension I was talking about. Right out of the gate, these numbers sent a really mixed signal to the market. In this table just lays the whole conflict out perfectly. You look at the revenue and wow, a solid $30 million beat. And their same restaurant sales or comps are up a super strong 4.3%. That's great. But then you look over at their earnings per share and it's a slight miss. Right there, that's the whole debate for investors in a nutshell. So this is really the heart of the matter, isn't it? People are clearly flocking to their restaurants, which is driving that top-line revenue number way up. But at the same time, higher costs are just eating away at the bottom line. And that divergence, that's exactly why the stock had such a choppy day. It popped at the open on the good news before the debate over profits kind of took over the conversation. Okay, so let's focus on the good news first, because it's pretty impressive. How exactly did Darden pull off this kind of top-line growth? Well, their strategy was crystal clear. Give people a ton of value, but do it without these deep, margin-killing discounts. And here's the thing that really stands out. Darden isn't just growing, it's absolutely dominating the competition. I mean, look at this. Their sales grew at more than triple the industry average. That is a huge sign that they are stealing market share, which is exactly what you want to see. It shows their brands are incredibly strong. Now, this didn't happen by accident. They had a playbook. That iconic never-ending possible, they held the price study, which screamed value to consumers and led to record engagement. Their partnership with Uber Direct is also proving to be a huge win, bringing in new customers. And this lighter portions idea is really working to change how people think about their prices. It's a smart, multi-layered approach. So what does all this add up to? Boom, a very, very healthy 7.3% jump in revenue compared to last year. This number right here just proves their strategy is working. It's resonating with customers and they are executing it beautifully. But you knew there was a bot coming, right? Strong sales are only half the story. Now we have to flip over to the other side of that tug of war, this really significant and stubborn pressure on their profits. And look, management didn't beat around the bush on the earnings call. The CEO came right out and said it. The number one villain in this story is beef. Prices have been stubbornly high, and that squeezed their profits everywhere, especially at LongHorn Steakhouse for obvious reasons, and even their fine dining spots. Now, this is maybe the most critical strategic decision they made all quarter. Darden is deliberately choosing not to pass all of its higher costs onto you, the customer. They actually raised their menu prices 1.3 percentage points less than their own costs went up. Think about that. They are intentionally eating some of that cost, sacrificing a bit of profit today to keep you coming back tomorrow. And that really brings us to the million-dollar question for anyone looking at this stock, right? Is this trade-off the right move? Is sacrificing your margins today to grab more market share tomorrow the winning play in this kind of environment? Honestly, the answer to that question is going to decide where the stock goes from here. So with all that in mind, what's the plan going forward? Well, their updated guidance for the rest of the year gives us a really clear window into their playbook for navigating these competing forces. And what's fascinating is that their guidance tells the exact same story as the quarter did. They're so confident in their sales momentum that they're actually raising their forecasts for both total sales and same restaurant sales. But they kept their earnings per share guidance flat. That's a huge signal that they fully expect those profit pressures from commodity costs to stick around, at least for now. So looking ahead, if you're following Darden, there are three things you absolutely have to keep an eye on. First, the full rollout of that lighter portions menu. Will it keep driving traffic? Second, the economics of their delivery business. And third, the big one, what happens with beef prices? Management thinks they'll start to ease up, but you know what? The market is pretty skeptical. Okay, time to bring it all home. Let's put everything together for the next call. Here's our final take on the quarter, our official rating on the stock, and an actionable trade idea that we've been watching. We are initiating coverage with a market perform rating. And look, this really reflects the balanced reality of the situation. We are super bullish on how well this company is run and their proven ability to get people in the door. But we have to stay cautious on the profit story for the short term, at least until we see clear, sustained proof that beef prices are finally coming back down to earth. So for the next earnings call, the entire narrative is going to shift. The question is no longer, can they drive sales? They've already proven they can do that. The new question is, can they expand their margins? And until we get a clear answer on that, we expect the stock to probably trade sideways, caught in its tug of war between the bulls who love the sales growth and the bears who are worried about the costs. And finally, let's look at how some traders are positioning themselves around all this uncertainty. We noticed some really heavy trading volume in what are called put options, specifically the ones that expire in December 2025 at a $175 price. Now, a put option just gives the owner the right to sell a stock at a certain price, so it's often used as a bet against a stock or to protect a position. The thinking here seems to be a hedge against the risk that these margin pressures last longer than people think. It's a way to bet that the stock might dip a bit before those cost issues get resolved. Of course, this is all for informational purposes. This is not financial advice.